There's this word defensive which we've used for FMCG always. Is it really defensive? I just wonder. 50, 60 P multiples with 2-3% growth. What is defensive about it? I mean, if you're buying these stocks, you're actually buying the highest risk with no growth and high P multiples.
Yeah, I tend to agree with you. And defensive also means that they protect some amount of the opportunity cost of investing in equity. And right now, the traditional FMCG companies are in a position where they're just about like a fixed deposit, keeping your money intact. And then there is a mild dividend yield, buybacks, and a slight appreciation in the stock price. So, from an investor's perspective, if you're buying into equity, you want to get businesses which can grow at 15-16% so that you can have a decent return. And that is not happening in FMCG. And that's more to do with the industry structure. I think a lot of the categories there have got very much mature and volume growths have petered out over there. And I don't think anything I can think of or imagine what can change this particular scenario. So it's best to avoid the traditional FMCG companies. There are lots of other plays in the consumption space, and that consumption basket over the last decade or so is steadily expanded. It could be QSR, it could be entertainment, it could be retail, healthcare, aviation. So there are so many choices. And I think that's where investors to focus on when they're looking at FMCG, when they look at a consumption theme and not definitely not FMCG.